Okay, so our first panel this morning, which will probably be the only panel that the room is somewhat full, is the impact of the pandemic on independent sponsor transactions. I'm going to let my panel introduce themselves, but I'll start at the end with James Illikman at Peninsula Capital.
Good morning, everyone. I'm James Illikman. I'm with Peninsula Capital Partners. We're a committed fund. We've been around 1995. We've been pretty dedicated to the independent sponsor space for most of those years. We've between 50 and 60 sponsor-led deals. And our model is to provide all the digital transactions. So we provide all the mezzanine as much as the equity is needed to complete the transaction. So happy to be here this morning.
Good morning. I'm Grant Kornman with NCK Capital. We're a local independent sponsor based here in Dallas. We acquire controlling interests with businesses and $2 to $10 million EBITDA. We have a portfolio of about 4 companies today. We just exited one a few weeks ago and are buying another, so soon to be 5. We focus on 4 key industries: any kind of service business, niche manufacturing, value-added distribution, and for-profit education.
Jonathan Saltzman. I'm the managing partner of Torque Capital Group. We are Northeastern-based independent sponsor. We've been doing it this way since about 2010, back when we were called fundless sponsors, until someone decided that sounded too much like homeless person. And so now we're independent sponsors. And we invest largely in auto and transportation. So the 4 portfolio companies we've got today are in steering, remanufacturing, starters and alternators remanufacturing. We make shift throttle and clutch cables, for example, also for the power, sports, and marine spaces. But we're process guys. We like manufacturing businesses. We'll bring in operating partners to run businesses, and we'll buy stuff that we think that we're uniquely qualified to own and to improve. $3 to $12 million of EBITDA is typically our sweet spot, and then we'll be looking for add-ons from day one after acquisition.
Good morning, Mike Becker with Plexus Capital. We're a capital provider to the independent sponsor market. We've done about 138 deals, deployed about $1.2 billion into this market. We were started in 2005. I'd say about 80% of our deals have been with independent sponsors, and we provide debt and equity to support the transaction any way we can. We also have 3 operating partners on staff that are value added to our independent sponsors around leadership, management, and really finance. So excited to be here and learn from these guys.
Hi, I'm Tim Laczkowski with Altacrest Capital. We're a Dallas-based independent sponsor, started in 2018. 2 partners. We focus on consumer product companies that sell online as a primary sales channel. It's a very topical focus for us. We have 4 portfolio companies, 2 of which we closed in the last 13 months, right through the teeth of the pandemic. And excited to be here and excited to share stories.
Terrific. So let's jump right in. This first one, we'll just go around the horn. We'll throw up a softball. So in your view, has the fallout of COVID turned this into a buyer's market? And if so, why? If so, what ways? And if not, why do you think that hasn't happened? Maybe just start with you, James, and we'll work our way back.
Sure. We haven't really seen it. We haven't seen it changing the dynamic, making it better for buyers. To the contrary, we've seen it probably a little bit better for sellers. And particularly if sellers have a company that has few to any blemishes, they're a very hot commodity in the market today. It's been probably more challenging for buyers because it's difficult to figure out if the company's had negative COVID impact or positive COVID impact. In either case, you've got to try to normalize that and figure out what a proper valuation structure is. It's probably made it a little more challenging.
I definitely agree with that. Valuations seem to be much higher this year than in prior years. And we think it's a lot to do with the middle market funds have all really paid up for their platforms in the last 12 to 18 months. They're coming down into the lower middle market and they're buying add-ons, and they're really paying some very aggressive multiples to dollar average cost, their valuation and their platforms.
Yeah, I mean, at the risk of sounding boring, I completely agree with the previous 2 gentlemen, which is I expected multiples to come down. I did expect some buying opportunities. We don't shy away from distress or restructuring requirements, but there frankly wasn't a ton of that in the COVID pandemic. And part of that's because there was government support for businesses. Part of that was, I think, just an overall acceptance of some of the issues that businesses were going to have with supply chain, with employees, with lead times, et cetera. And so there was simply, if customers are going to accept and acknowledge that you've got issues and they're going to relax terms or lead time penalties and stick with you, then, there's going to be fewer folks that are out there that become cash constrained and looking for investment. And so, it's I think a positive for the economy, which is a good thing. But as a buyer of assets at value, we didn't see as much as we thought we would.
Not much to add. I think there was an opportunity maybe from March 11th to probably July. And then PPP really rescued a lot of companies. And COVID is responsible for some of the things I think now driving a lot of what we're seeing and the uncertainties around regulatory, tax. I think a lot of the baby boomers, while the market is so hot, said I went through 08, 09. Man, I just went through COVID, I got through this. It's time. I'm ready to go. And I think that's why the market is just, I feel like companies have been brought forward into 2020 based on I went through COVID, tax policy that could change here September 13th retroactively, or more like January 1st. That's just brought a ton of companies forward, and the amount of money and the amount of private capital that is ready to be deployed is at an all-time high. So those things, all supply and demand, create a really hot environment for M&A activity right now.
And the only thing I would add to that is a kind of a piece of our segment, the consumer product side. We are starting to see cracks on some companies, especially direct to consumer businesses, with some of the issues revolved around iOS operating system changes as well as supply chain. We've been receiving calls the last month or so with regard to kind of more turnaround situations for really good branded products that just gotten themselves a little sideways. We've seen a number of transactions paused, for the fourth quarter in that space. And so I think that's part of where we're starting to see maybe a little bit of the pull through that you described, starting to take a little bit of heat. And our anticipation is we'll see 2022 where those opportunities, we think there could be some pretty interesting buying opportunities there. I don't think the valuations are going to be like incredibly low. I still think it's going to be a healthy situation that we're going to have to get into and probably have a lot of structure in, which we'll talk about, I'm sure, here in a minute. But that's the only thing that I've seen that would be contrary, a little different take on it is definitely a seller's market.
So we'll get into a little bit the view looking forward, but just going a bit off script to tie back to something both Mike, you and Tim referred to, which is 2022 in this environment, this market. What is how do you view the next 14 months? Do you think they're going to be consistent with what we're looking at right now?
Yes. I'm not sure how it stops. I mean, we either want to be business owners or we're invested in business owners, and it's been no tougher time. I mean, we have 55 portfolio companies right now, and 52 of them are talking about labor and supply chain. And everything I read says that supply chain is probably, best case scenario, 8 months, worst case scenario, 16 months. And we all know the credibility of that. Who knows? So, I mean, I think it's really hard to be a business owner right now. So I think this M&A market will continue to push pretty heavy for the next 12 to 18 months, depending on, inflation, other dynamics of where cost of capital can change pretty quickly overnight. But I think it's going to be a hot market for a while, would be my opinion.
Yeah, I mean, we were talking about this over dinner last night. I mean, especially in the world that we deal in, transportation auto, we've been through, not just supply chain, which everyone's dealing with, health factors, employees, et cetera. We're dealing with chip shortages. We've dealt with tariffs. I mean, it's been, such a turbulent couple of years relative to all those topics that, it doesn't feel like there's much in 2022 that we don't already know about that's going to have as significant a force as those kind of perfect storm type factors that impacted.
Just wait.
Maybe COVID 22. I don't want to. So, it just feels like there's definitely going to be some bumps in the road. Recoveries are going to be slower and everything takes longer than you'd like and costs more than you'd like, but it's going to resolve itself. And so we feel supply chain issues are timing issues generally. And, we're kind of all in the same boat relative to COVID and what's the impact on our customers, on our employees, on our suppliers, and how we deal with it. So, back to the point around, relative success, I think everyone's kind of, pretty much in the same boat there.
You mentioned something that I was going to drill down on, which was the discussion around supply chain. Is what we're seeing solely attributable to COVID, or is there still tariff impact on that?
I can speak a little bit, specifically to the auto side of things and the transportation side of things, and there's definitely some tariff overhang. What I will say is some of our businesses have gone out and resourced components to India, to Taiwan, even reshored some manufacturing, taken in-house some manufacturing and do it in Mexico, in limited cases back in the US. And so I think tariffs have been out there long enough that people have had time to react, and people have made the determination that, the investment, is in, and always with these, politically driven initiatives, you've got to worry about, what happens in 4 years' time, and will I've wasted my money? So, what you got to do is ultimately, what's the ideal supply chain and manufacturing footprint? And if, this is what it should look like in 5 or 10 years, I'm going to try to see through tariffs. And people we're seeing not just were you getting away from tariffs by going to Mexico, but you were improving on freight, you were improving on the labor side of things. And so it just kind of made sense. I think that one, anything that's got certainty to it is much more manageable.
Right.
Anything that's like COVID that has no certainty to it, you hate to be making decisions without full information, but sometimes that's what we're asked to do.
So Grant, going back to what you said with where you're seeing larger PE funds with platforms coming down market for add-ons. Yeah, it's a segue into what I was going to ask, which is, have you experienced any change in bidder makeup? More strategic buyers, increase in management buyouts, larger PE coming down market?
Yes. I think every process where it's run by a kind of a low-level intermediary to a very sophisticated investment bank has more participants today than ever before. There's a lot more of us independent sponsors in the world out there looking for interesting investment opportunities. Funds are obviously below their deployment targets, both in the lower middle market and middle market. And so, they have LPs putting pressure on them to deploy capital. As I was listening to our remarks this morning, we're talking about, is it a buyer's market or a seller's market? And I can't remember a time where it was ever a buyer's market. and I guess you don't really know when you're in one until after the fact. It always feels like a seller's market. And I think that's still very true today. We've also seen a difference in quality this year of companies because of tax changes, because of the pandemic. It's brought a lot of business owners to market. And so it seems like there's just all the businesses are really very good. And we tend to be attracted to opportunities where there's more value creation than necessarily perfect shiny diamonds. And we've just seen a lot less of that this year, even at the third and fourth tier intermediaries that generally have hairier stuff. They have really shiny pennies these days.
I was smiling earlier when you said low-level intermediary, and now you've said, so remember, this is all capital providers and sponsors. You can say crappy investment banker here. That's really what you're saying.
Maybe something like that.
Anybody else want to jump in on this?
Yeah, we've seen the same thing, and I think to some degree it's a function of it's the uncertainty in the market right now. So companies that are, like I said earlier, that have very few blemishes on them are getting a lot of attention. But the stratification between moving a company that's a high quality, very clean company in the market and something that's a little bit more of a hairy situation is, the gap between those two is very great, and buyers are bidding very high prices for high quality companies. And the moment they see something during the due diligence process that brings that into, brings a blemish into light, there's a significant retrade or they're more likely to walk away from the deal than what we've seen in prior years.
Those are the interesting dynamics of the market right now. We just exited a company, didn't actually go exclusive. It was PE-backed strategic until 15 days before closing. Like the power of the investment banks right now is crazy. So people are spending tons of money with non-exclusivity in order to understand the business to try to win, which I've never seen in the market.
At this level.
And so it's a really interesting dynamic. And to Grant's point, I think when you think of supply chain, you also got to think about what's the capital supply chain, and the LPs or the large aggregators of capital, because of COVID, are not really searching out new opportunities. They're more re-upping with their existing players. And so they have even more capital to put to work. And so that's another point of when you think about valuation, obviously there's fundamentals to it, but there's also just money flows. And the money flows coming out of what I've called the middle market, private equity world, or capital prevalence is just so high that it's driving multiples larger. Now, different than 0809, 0809, we had debt equity of like 80-20. What we're seeing in the market on the underwriting side when we provide debt versus the equity is, we're seeing 70-30 even in some transactions of equity to debt. So 70% equity, 30% debt, more 50-50, even maybe 60-40. But that's the big difference in what I see versus 0809 when we went through kind of that. Everybody's talking about leverage is really high. Leverage is really high right now, which says the equity account. And if you really believe that the clearing market price is the right enterprise value, then you've got a lot of cushion.
Well, I'm gonna stop right there because you mentioned where I was gonna go next. I was gonna ask what's the difference from the Great Recession. I remember speaking to one of my clients back in 2008 and saying, hey, I don't get it. Why are we, why is everything shut down? I get up market, but the capital's here. This was a lender said, you have your fund committed. Why are we not seeing deal flow? We were busy doing restructurings, but it was nothing like this last year. I mean, there was just no deals happening. He said, it's not about capital, it's about valuation and certainty, right? Where, the last 12 months is just garbage thrown out the window until we get a pathway of 12 months out. We can't value anything. So what's different now? Why have there been, deals happening? How are you bridging that valuation gap? The question that I had sent up before you guys, are you seeing a proliferation of contingent payments, earnouts, other things to sort of bridge valuation? What are you seeing and why is it different now? Why, as opposed to 08, 09, when it seemed like there was a period where just deals weren't happening?
Well, I mean, 08, 09, if we all remember it, I mean, literally the world it stopped, but it didn't stop for 6 weeks, right? It stopped for a longer period of time and it was across, every industry, right? And I recall literally talking to one of my clients then where they said, we don't even know, we've got our warehouse stocked now. We got to shut everything down because we're too full. This was like 6 weeks or whatever, 2 or 3 months in certain industries. And then it ramped right back up. Like there was no gradual incline for us to see on sales. And that has just, it's been remarkable. It's what's choked off a lot of for companies we look at. It's created a lot of problems.
I think PPP also played a factor.
Huge. It was enormous.
All these companies survived where they keep their infrastructure. And when demand came back, they just didn't miss a beat. And I feel like the second half of 21 has been a lot of businesses that have rebounded. And you can underwrite their business, even though they may have had a big pullback in 2020.
You're looking at what they did in 20, but for us, we go back and look at 19, kind of, March, we figure out adjust 20, and then you look at 21, you're like, all right, well, where are we today? And you try to figure out what sector is going to perform going forward. In structure, we're seeing, we're being encouraged by the banks to put structure in our deals. And that's been something that they've coached us very well on, to try to hold on to some of that value that maybe a buyer doesn't want to give you credit for that for some of these jumps that we've seen because of PPP, et cetera. So that's our experience.
PPP's been mentioned now several times. I wasn't planning, I didn't even have it in my list, but without asking you to get political, just stepping back now, a year later, as as buyers, is from a policy perspective, ignoring the implementation of it and just it was rushed. There was weird things about it. But as a policy, was it the right thing to do? Was it a good thing?
It's the greatest government program I've ever seen.
Yeah, without a doubt. It's
I
awesome.
mean, it was incredible.
It saved our economy.
James, you were about to.
Well, I was just, relative to PPP, unfortunately, from some of the larger private equity funds, we didn't qualify because of the aggregation rules for most of our portfolio companies. So, but definitely, we've benefited from, picking up a lot of smaller add-on acquisitions that did. And so that propped those companies up and kept them alive and gave them, some exit opportunities. So.
Yeah, we had to navigate some affiliate rules around sort of the PPP requirements. And as an independent sponsor, you're fortunate, you have separate structures that are isolated and they've got different managements and they've got different boards and ownerships and so forth. And so you don't necessarily get caught up in some of those affiliation rules, but we certainly believe that PPP was a program that actually, it extended the runway for a lot of these good companies that, would otherwise have not made it if it was an 08 type, situation. And, that's good for the economy, and that created buying opportunities for us. I think PPP in some odd way created, some more stable platforms to look at coming through it.
I haven't heard a single private equity investor or business owner go, PPP, it was terrible.
The 0809 question, this one was much more industry driven, as we look across kind of 50 companies, if you're in the middle of the grocery store chain, it was COVID was a great thing, which is hard to say, but if you're in, hospitality staffing, which we funded in February of 2020, not a real good thing, right? I mean, we were even with PPP, and, we had probably doing 2.5 million of revenue a week to zero in a 48-hour period. And so I just get excited about what America can actually do when it's forced to do it from an innovation standpoint, and how, when you're really tested, it survives. It's a really cool dynamic of just American economy.
So back to just drilling down on the question then on the valuation gap and structuring. Have you been seeing unique structures in your transactions you've closed this last year to help bridge this gap?
I'm not sure if I've seen unique structures, but we've seen that they're much more common. So, and they're more accepted. I think part of it is that because it is a seller's market, there's valuation expectations that the sellers are looking for, but there's also financing kind of, headwinds for that. So regardless of what the valuation is, you still got to be able to finance the deal. And sellers are more willing to take some structure in the transaction to get the valuation they want. But I also think that part of the driving force behind that is the change in tax regime. So you've got, this kind of pent up transaction activity because of COVID, and then it's getting compressed because of people wanting to get transactions done by the end of the year. So it's created some flexibility on structure.
I've never liked earnouts. We don't typically use them in structures. I think they're misaligned. Right out of the gate, you've got, a former owner operating under a set of incentives to hit whatever metrics their earnout is defined upon in a specific period of time, versus an owner who's looking at this from a long-term perspective. And, I think I know a lawyer out there who's got an entire practice out of litigating earnouts, and
They're inherently flawed. I mean, from the time you're drafting them, you're arguing about trying to sabotage. I was like, what?
So they're hard. I know that it's an attractive way to try to bridge a valuation gap and get a deal done. But what we prefer is if we really believe in the story and the value creation that we bring to the table, which we always do if we're going to do a deal, we try to increase the equity rollover. And so, yes, you're getting, a check that's slightly smaller than you thought you wanted, or, you thought you'd get even at the beginning of the process. But, looking at the upside, 3, 4, 5, however many years down the road, your second check might be bigger than your first check. And, we love assuming the dynamic makes sense, that you want that seller and founder and so forth involved in the business going forward. That's a good way for us to totally align incentives and, give these guys a way to bridge a perceived valuation gap.
Great. Let's move a little further in the deal then to talk about due diligence. How has COVID impacted your due diligence process and coming out of it, has it created sort of in your mind, a best practice or new practice that you're going to take, going forward to implement in your deals that you otherwise maybe hadn't thought of or weren't
I
doing?
think in terms of a new practice, definitely supply chain due diligence and customer financial health due diligence. So, everyone's always looked at diversification amongst your suppliers and your customers, but we didn't spend nearly as much time pre-COVID trying to understand the financial health of suppliers and customers. And where are the pinch points in the supply chain? So if we've got a business that's 100% dependent on importing product from China, that's going to create, a need to have a much more broader eye set on that and trying to figure out what are contingency plans if supply chain gets disrupted. It's something you thought about before, but just candidly, it didn't get in our shop. It did not get nearly as much attention as it's getting now.
I think to add on to that too is labor. Different parts of the country respond to labor issues differently. And so that's something that we didn't focus on as much, the inflation of labor. Also, one thing that we kind of started looking at now to that is pricing power more is something. If you can't raise prices right now, I don't know when you can ever raise prices. And if you don't have the ability to raise prices in your company right now, then are you really creating any value?
Remember that when you get your legal bill next year. You just said it. Dana,
Next year.
they might be all aware.
The only people who are decreasing prices is the debt providers right now. But it's a really good and just global viewpoint from our standpoint of, can you raise price in a market that is willing to take price increases pretty much in any industry at this point in time? And so that's a real good value indicator of the service or the product or whatever you're offering to the market is, can I take more price? Because costs are going up. And I just don't see an end to that for a little while.
Mike, to your point on labor, it's not so much a due diligence issue, but an underwriting one. We as a firm generate more value creation through organic growth than inorganic. And so when we think about potential investment opportunities, we're going, hey, if we want to double this EBITDA or triple it, how many people do we need to hire? Is it 50 or is it 500? Is it 1,000? Those are very different tasks in today's marketplace. And so when we go through our underwriting and think about growth, it's, hey, can we even get the bodies to do this?
Availability. Yeah.
Well, and the supply chain piece that you described, as an independent sponsor, we're feeling a lot more questions from our investors about supply chain. And I mean, when we go to groups like yourselves, they're saying, yeah, it's in China, but what are you doing to offset that? Like, what's your plan for new products? Or are you going to stay there? And it's become more and more of a conversation. And it's something that we're really working hard with our portfolio companies to think differently about going forward.
I think from a standpoint of trying to predict the next pandemic or the next 0809, we don't really look at that. I know that was one of your questions, David, but I just don't know how to underwrite that. And so
So this next question, it's stupid to even ask because I'm getting calls from clients wanting to close, buyouts in 3 weeks. But are you seeing, as real as some of the drags on the process, are you seeing longer exclusivity periods or periods to close? No, me neither.
No.
I think I just told you 15 days was the one we had. But the third-party providers obviously are busy. I'm sure everybody knows that. And that's the piece of the puzzle that's holding us up as much as anything.
David, are you asking, is it taking longer to close or are we able to get longer timelines to close? Because because I can't remember the last deal we closed that did not involve, especially with an independent sponsor deal, an extension of exclusivity.
Right.
I'm just going to get a folder that just has them drafted and just fill in the name of the company, because it happens every time.
Yeah.
Prior to this kind of rush to the end of the year because of taxes, I think COVID had actually kind of lengthened the transaction process. And I think sellers were more accepting of a longer process because it was more difficult to get through the due diligence. There was, the performance of the companies was less stable. So you're trying to underwrite, whether it's up or down. But now that's all got compacted because of, the rush to get transactions done and avoid capital gains. That's even possible after September 13th.
Yeah,
you mentioned.
right.
So might be all for naught.
We've had a lot of conversations with bankers on timelines where they say, hey, we want it to be, pick your numbers, 60 days, 75 days. And you go, well, listen, I can't even get a QME provider started for 2 or 3 weeks. And let's not even talk about rep and warranty insurance underwriting. I mean, we didn't even know. And their answer is, well, let's just agree to it. We'll figure it out when we get there. And it's a little uncomfortable for sure.
Yeah, we put in an LOI yesterday, and in it, we were asked, who's going to be your QOE provider and so forth. And we're like, spin the wheel, whoever's ready first. We have a number of guys we've talked to. They've each quoted, 4-6 week lead times, folks that we've worked with plenty in the past and that, are prioritizing us, but, quote unquote, but just have no staff to put on it. So, and from my perspective, in terms of diligence during COVID, I think, the one thing that's been trickiest is when there were travel bans and when it was difficult to travel and there were all kinds of restrictions and so forth. We would never close a deal without seeing a facility. We're in manufacturing typically, and we need to kick the tires and kind of see the place. B, and probably more importantly, you get so much out of, conversations with management teams and employees, et cetera, outside of the management presentation, in the car on the way to dinner, when you're at the airport because you're both on the same flight out, walking around the facility from the CFO or the head of ops, and, those kind of invaluable, pieces of color around the business, are really important to our assessment of the business. And if we're not able to do that, physically see the place and really look some of these folks in the whites of the eyes, we won't do a deal. So, fortunately, we didn't miss any because of that. There were 1 or 2 that we were asked to do that way, but they ultimately weren't the right fit for us. And then by the time, we got through to, it was late 20 when we started traveling, and we were able to get to a facility, and we ended up closing that deal in April, having spent some time live with the team. So that was the bigger impact to our diligence process. I don't think that's as much an issue anymore. I think for the most part, we've done some virtual management meetings. We did one last week, but I don't think anyone's of the expectation that we're not going to go, see the facility before we make a binding decision.
So we were talking about best practices going forward, and maybe, Mike, you said dealing with sort of the next pandemic that you really just can't plan. So we talked about, Grant, you mentioned focusing on labor and how you can hire. So just shifting the question a little bit, just for you, Mike and James, has this changed how the types of independent sponsors that you will work with and maybe focus on working with?
I think from Peninsula's perspective, we've been pretty focused on having independent sponsors that evaluate the process. So I think, having a good relationship between the independent sponsor and the management team, if anything, that's become more of a focus because the management teams got so stressed going through these processes that kind of any external force adding to that stress, just kind of throwing gasoline on the fire. And, guys who could roll up their sleeves and help the management teams get through something that none of us have ever been through before just proved to be invaluable. So looking for that kind of the right kind of personality match between the management team and the sponsor partners is definitely higher on our list at this point.
I would agree. We're committed to this market. I think we've been committed to this market since pretty much we started in 2005. And just like deals, independent sponsors and capital providers come in all shapes, sizes, and colors. There is an underwrite of what is the dynamic of the independent sponsor and the management team, and are they aligned on strategy, and are we, we've required more of 100-day plans, or hey, let's all get on the front page where we want the business to be in 100 days or 180 days. Because that's really the hardest part. And we understand by investing in this market and doing, over 100 deals, that there's speed bumps. I mean, these are little companies that have, 1-2 key people in them when you purchase them or the transaction goes down. And so really building a structure that can take a couple of speed bumps before they take off. If we look across our portfolio, we've exited about 71 so far in our history. The first year and a half is most of the times it's kind of bumping along. And then you start to either get, really good expansion, or you're in more of a, okay, what do we need to do to change what our dynamic is on a going forward basis? So it's really about that relationship and being aligned at the front on what do we want to do from a value creation? What do we want to do from an employee? What do we want to do from a branding? All the dynamics of value creation, but just alignment is really key around capital partner, independent sponsor, and management team.
So flipping it to the independent sponsors on the panel and piggybacking on that alignment and the speed bump point, coming out of the last year, we're dealing with portfolio companies and needing to, fix balance sheets and really rely on that relationship. Or do you view your relationship and how you choose capital partners maybe differently now, maybe less focused on best transaction terms and maybe a little bit more of a investigation and drilling down into, the patience, the fortitude, the working relationship with the capital partner? Is that becoming maybe more important than the best economic terms on the deal, the best carry? Or is it still about the best carry?
Best economics. For us, it's always been relationship driven.
Yeah.
We've been fortunately been in this industry long enough. I think we know almost all the capital partners in this room, and picking a partner is probably the most important thing you do as an independent sponsor. Having good alignment in your vision for the investment, having a good working relationship with your capital partner, all those things will have a bigger impact on your ultimate economics than necessarily the terms, but the terms are also incredibly important.
Yeah, I agree. It's never been about the best terms. I mean, the market's pretty efficient, and you're going to find folks in different categories for what you need in the capital structure that are going to be in and around the right terms. And so it's far and away about flexibility, patience, communication, how they're going to operate when, things turn bad, how they're going to operate when you've got a great growth opportunity, how they're going to operate when something unexpected happens. So, it's for us anyway, rarely about, getting the best terms. I mean, within a range, we'll certainly look for best, in market, best market terms, but that's not going to turn the deal.
I do think the last 18 months have really put a spotlight on the quality independent sponsors and the quality capital partners. I was having a conversation with a friend of mine yesterday who's another independent sponsor in a company that was highly impacted by the pandemic, rebounded, doing great. And he's like, my capital partner was fantastic. They were patient with me. They could have used it to totally cram down my economics. They didn't. And I will always refer them to new independent sponsors, and they'll be my first phone call. And conversely, I think capital partners are comparing notes. These groups did a great job dealing with this very stressful environment. They worked hard, even though it was unclear whether there's going to be any economic reason to do so. And so I think the last 18 months have been a real good test for the ecosystem in this marketplace about which independent sponsors can do a good job creating value in tough times, and which capital partners are fair and flexible when they need to be.
We closed 2 deals in the last 13 months in a party supply company and a blanket company, right in the middle of the pandemic. And the only way we got those deals done was because of the relationships we had with those capital partners. And they stepped up right into it. They were there with us in diligence. They were very supportive. They saw the longer term vision. And so that was huge. When I think that, to your point about the last 18 months, I think it's been important to remember that, and that's, probably bidding against myself here, but it's not about every last basis point. It's about getting that right deal at the end of the day.
It's funny how it's funny how that theme is consistent from the sponsor to the capital partner to the sellers. One of my PE clients mentioned once that he's never had a conversation with the seller where they lamented not taking the most money. It was always around choosing the wrong partner. And so it's interesting how it's funny how we're in business about maximizing return, but it's not always about the quantitative, right?
You also tell a lot by when you start those early, especially for us, the newer, the group up here than the rest. when you get the terms, kind of on an email or something like that, you start talking about, and if you're way off, like, just, it's not going to work, right? All of our partners, there's not really a negotiation, right? There's a handful of conversations, and all those groups tell us, like, it's a few conversations. And then we're worried about the business, we're worried about how are we going to grow, what are we going to do, what do you need us to help with, that type of thing. So I think it's important to, at the very beginning on the onset, you get an indication of where people are.
Right. And Tim, to your point, I think this market's matured a lot. The terms are in a very narrow band today. It's really changed.
Yep.
It's more about finding the right fit. And, if there's one term that's a little better or worse, usually you can talk to your preferred partner and say, hey, I don't want to twist your arm here because this is a long marriage. Right. But I'm saying no to this. And this would make it much easier to say yes to you. Right. And, they'll generally work with you.
So I think we have a few minutes left. Let's end with kind of two questions. One's a two-parter. So we hit on best practices on managing portfolio companies and diligence, but has the pandemic changed how you source and identify new investments? And sort of the related part of that is it caused you to focus on any particular industry that maybe you weren't focused on, or avoid an industry that you were? Tim, you mentioned again how just at the beginning, how just we were talking about buyer seller market, how in the consumer space it was a little different. So we just kind of maybe just go through starting on the end, James.
I don't know that we've changed but definitely our sourcing model hasn't changed. We're dependent on independent sponsors for that. So, but as I mentioned earlier on the supply chain, we're much more focused on understanding where those pinch points are going to be at supply. So, going to the extreme, if the business is 100% dependent on importing product from Asia, particularly from China, we're going to spend a lot more time and attention understanding, are there alternative sources of supply in China? If one of them gets disrupted, are there onshoring opportunities? Is there, Mexico or Central America manufacturing alternatives? So those are things I think we're more focused on in the sourcing stage that we wouldn't have been before.
Yeah, I don't think we've changed the way we source investment opportunities. We definitely had to change the way we evaluate them. Volume is up for us an enormous amount this year. And so figuring out a way to get through those opportunities efficiently and really developing a good set of parameters to evaluate them, because it is harder. I mean, it's harder to underwrite. The hardest thing to underwrite today is probably pandemic growth. It's easy to underwrite pandemic weakness that's rebounded. And so how do you sort through those opportunities efficiently and find the opportunities where we can be competitive and we think we can create a lot of value? It definitely has been more challenging this year.
For us, we haven't changed our sourcing strategy much, which is typically going through CEOs and executives of our portfolio companies, operating partners in our networks, looking at customers, competitors, suppliers in our chosen markets. Because we're industry focused, we have a finite universe, and we'll try to do deep dives on particular trends in those subsectors that we like. So our sourcing initiatives haven't changed. I will probably say that our assessment of businesses, once they've kind of been entered into the funnel, has changed a little bit based on how they've reacted or not reacted to the pandemic and to the supply chain issues, and if it's not a business, to the chip shortage, to tariffs and so forth. And it tells you something about the financial stability of the business. It tells you something about the leadership and the management. It tells you something about the particular relative value of their product in their marketplace. It tells you something about their control over their supply chain and their thoughtfulness around how they're getting product and where it's coming from, whether they're making it versus buying it. It tells you something about their adaptive ability to adapt. So less so on the sourcing, a little bit more on the assessment of businesses.
Okay. As a generalist, we really haven't changed much. I mean, we're obviously looking at COVID impacts, margin impacts. But the nice thing about COVID is who's sustainable and who's not. That was something that was brought out through the pandemic. And like I was saying earlier, each industry category that we invest in reacted differently to the pandemic. Tech pretty much just kind of stayed stable. If you're in a consumer product, e-commerce is, really great. Sourcing and manufacturing was tough. So it gets more specific to the industry that we're looking at according to the transaction that we're trying to underwrite and provide capital to than anything else. And it always has been that way.
Yeah, I mean, our sourcing hasn't changed. But I would say that's what has been, I think, more important. And my partner, Brian, is always the one that points us out more in our deal evaluation. It's what's our angle here? When describing these funds coming down or more competitive marketplace, we just have to be more nimble and find that angle. Is there a relationship we can develop with the management team? Is there somebody we have as a way to differentiate ourselves in the mind of that buyer? The seller as a buyer, because it's just so competitive right now. And it's always been that way. You've always had to have an angle, I think, as an independent sponsor, but I think just been heightened in this environment.
Well, we're at a time, I was looking at my watch, which is 5 minutes behind my, the real time. So apologize for the next panel. We could have kept going for another 30 minutes. I think I hit half my questions. So I knew we'd be able to have a great conversation around this, and really appreciate it, guys.
Thank you.